On the surface, nothing seems out of place. Silver prices move slowly, almost quietly, as if the market is calm, controlled, predictable. But beneath that calm, something doesn't add up. Because while the price suggests stability, the underlying signals are telling a completely different story. Industrial demand for silver is climbing at a pace we haven't seen in years. Critical sectors, solar, electric vehicles, advanced electronics, are consuming more silver than ever before. At the same time, supply isn't keeping up. In fact, for multiple consecutive years, the market has been running in deficit, quietly pulling more metal out than it's putting back in. And then there's the part most people never look at. Physical inventories are shrinking, not collapsing overnight, but steadily, consistently being drawn down. Ounce by ounce, shipment by shipment, silver is leaving the system. Yet the price barely reacts. No spike, no urgency, no signal that anything is wrong. So the question becomes impossible to ignore. If demand is rising, if supply is tightening, if physical silver is quietly disappearing, then why does the market still look so normal? Because either nothing is happening, or something much bigger is building beneath the surface, and it hasn't been priced in yet. And if that's true, what exactly is forming right now? And more importantly, why isn't the market reacting to it? Before we go any further, it's important to understand what this is and what it isn't. This is not a prediction. It's not a hype-driven call. And it's definitely not another attempt to chase short-term price moves. Because in markets like this, headlines can be loud, emotional, and often misleading. We take a different approach. We don't follow headlines. We follow structure. We pay attention to what capital is actually doing, where physical assets are moving, and how supply and demand are quietly shifting beneath the surface. Because the biggest moves in financial markets rarely begin with obvious signals. They begin with subtle imbalances that most people overlook. And right now, those imbalances are starting to form. The goal here is simple, not to convince you of a specific outcome, but to walk through the data, the behavior, and the patterns that are already in motion. Because when you step back and connect the right signals, a clearer picture begins to emerge. And it's not the one most people are seeing. Over the past year, something has been quietly shifting inside the silver market. Not in a way that dominates headlines or triggers immediate reactions, but in a way that slowly builds pressure beneath the surface. It starts with demand. Silver is no longer just a precious metal sitting in vaults or traded for speculation. It has become a critical component in some of the fastest growing industries in the world. Solar energy alone is consuming increasing amounts of silver as global energy systems transition toward renewables. At the same time, electric vehicles, advanced electronics, and emerging technologies continue to rely on silver's unique conductive properties. And that demand isn't slowing down. But while demand accelerates, supply tells a different story. Most silver isn't mined as a primary resource, it's produced as a byproduct of other metals. That means increasing supply isn't as simple as turning on more production. It's constrained, slow to adjust, and often dependent on entirely separate markets. The result? Year after year, the market has been running in deficit. More silver is being consumed than produced. At the same time, inventories across major exchanges and storage systems have been gradually declining, not dramatically enough to cause panic, but consistently enough to matter. Ounce by ounce, the available supply is being absorbed. And this didn't happen overnight. It built slowly, quietly, almost unnoticed. Each individual piece seems manageable on its own. But when you step back and look at the full picture, it becomes something else entirely. Individually, these shifts seem small. Collectively, they are starting to look significant. And this is where things start to feel off. Because if demand is rising the way it is, and supply is tightening the way we've just seen, then the natural expectation is simple. Price should respond. Not perfectly, not instantly, but noticeably. Yet that's not what's happening. Instead, the price of silver moves slowly, almost reluctantly, as if none of this pressure exists. As if the growing imbalance beneath the surface isn't real. At the same time, something else is happening in parallel. The volume of silver being traded on paper markets, futures, derivatives, synthetic exposure, is massive. In many cases, it dwarfs the amount of physical silver actually available. Contracts change hands at a scale that suggests abundance, while the real, physical supply tells a very different story. So on one side, you have tightening availability. On the other, an overwhelming sense of liquidity. And those two realities don't match. Even more interesting is what isn't being said. Mainstream coverage remains limited. There's no widespread narrative explaining this disconnect. No urgency in the headlines. No signal to the average investor that anything unusual is happening, which creates a strange divide. The public sees stability, but beneath the surface, institutions, industry players, and informed capital are watching something else unfold entirely. And that leads to a question that becomes harder to ignore the deeper you look. How can pressure continue to build without any visible release? Because markets can absorb imbalance for a time, but they don't ignore it forever. To understand what's really happening, you have to separate two markets that most people assume are the same. But they're not. There's the physical silver market, the real metal, mined, shipped, stored, and consumed by industries that actually need it. And then there's the paper market. This is where most of the price discovery happens. Futures contracts, derivatives, and synthetic positions are traded at enormous scale, often representing silver that doesn't physically move at all. It's exposure, not ownership. Liquidity, not scarcity. And this is where things begin to shift. Because when price is driven primarily by paper activity, it doesn't always reflect what's happening in the physical world. It reflects positioning, sentiment, leverage, and short-term incentives, not necessarily long-term availability. At the same time, stability matters. Financial markets are built on confidence. Sudden, uncontrolled price spikes, especially in critical commodities, can create ripple effects across industries, currencies, and broader economic systems. So there is a natural incentive to keep movements controlled, gradual, and predictable, not to suppress reality indefinitely, but to manage how and when that reality shows up, which leads to a more uncomfortable possibility. What if the current price of silver isn't wrong, just incomplete? What if it's not failing to reflect scarcity, but delaying it? Because if the physical market continues tightening while the paper market maintains the appearance of balance, that gap doesn't disappear. It grows. And eventually, it has to resolve. Not slowly, not quietly, but all at once. And if that's true, then what we're seeing right now isn't stability. It's tension being held in place for now. When you strip away the noise and look at the mechanics of the silver market, the imbalance becomes easier to see. Start with supply. Unlike gold, silver is rarely mined on its own. The majority of global silver production comes as a byproduct of mining other metals like copper, lead, and zinc. That means supply isn't directly controlled by silver demand. Even if prices rise, producers can't simply increase output without changes in entirely different markets. At the same time, ore grades have been declining. Mines are producing less silver per ton of material, which increases costs and slows expansion. New discoveries are limited, and bringing new projects online takes years, not months. So supply remains constrained, structurally, not temporarily. Now compare that to demand. Silver is no longer just a store of value or an investment asset. It has become deeply embedded in modern infrastructure. Solar panels rely on it. Electric vehicles depend on it. High-performance electronics require it. As these industries expand, silver demand scales with them. And this isn't cyclical demand. It's structural growth tied to long-term global trends. The result is a pattern that has repeated itself year after year: deficits. More silver is being consumed than produced, forcing the market to draw from existing above-ground supplies. And those supplies are not infinite. When you compare this to past cycles, the difference becomes clear. Previous silver rallies were often driven by speculation or monetary conditions. This time, the pressure is coming from both industrial demand and supply constraints simultaneously. That combination is rare. And when you step back and look at the full picture, constrained production, rising demand, and consistent deficits, it becomes difficult to frame this as a temporary imbalance. This isn't a spike. It's pressure, and it's been building for longer than most people realize. But this story doesn't exist in isolation. When you zoom out, silver stops looking like just a commodity and starts to look like a piece of a much larger shift taking place across the global system. Because at the same time this pressure is building in the silver market, something else is happening at a macro level. Countries like China, along with other emerging economies, have been steadily increasing their focus on securing physical resources, not just silver, but energy, metals, and strategic commodities across the board. The goal isn't short-term profit. It's long-term security, ownership over access. At the same time, there are growing signals of de-dollarization. Nations are exploring trade outside the traditional dollar system, building alternative frameworks, and reducing reliance on a single financial center. And in that kind of environment, physical assets start to matter more. Because unlike currencies, they can't be printed. This creates a clear contrast. On one side, you have the West, where markets are heavily financialized, and value is often expressed through derivatives, leverage, and synthetic exposure. On the other side, you have the East, where the focus is increasingly on tangible assets, real resources, and physical control. And silver sits directly between these two worlds. It's not just an industrial metal. It's not just a monetary asset. It's both, which makes it uniquely positioned in a system that may be slowly transitioning from one form of value to another. And that raises a deeper question. Is what we're seeing in silver really about price movement? Or is it part of something larger? A quiet preparation for a different kind of financial environment altogether? From here, the path forward becomes less about if something happens and more about how it happens. Because when pressure builds inside a market like this, it doesn't disappear. It resolves. The only uncertainty is the speed of that resolution. The first scenario is gradual. In this case, silver begins to rise steadily over time. No sudden shock, no dramatic spike, just a slow, controlled repricing as demand continues to outpace supply. The market adjusts step by step. Investors have time to react. Positions can be built. The opportunity window remains open, even if it narrows over time. It's the kind of move that feels manageable, predictable, even. But there's a second scenario, and it looks very different. Here, the imbalance doesn't resolve slowly. Instead, something triggers recognition, perhaps a visible shortage, a breakdown in physical delivery, or a sudden shift in sentiment. And when that happens, the gap between paper pricing and physical reality closes quickly. Price doesn't climb. It jumps. Liquidity tightens. Volatility expands. And the systems that once kept everything stable begin to lose control of the pace. In that environment, the market doesn't wait. It reacts. Both scenarios lead in the same direction, higher. But the difference between them is everything. Because one gives you time, the other takes it away. And right now, the signals don't clearly point to which path will unfold first, only that the pressure behind both is already building. So what does all of this actually mean in practical terms? For long-term investors, the picture is relatively clear. Silver begins to look less like a speculative trade and more like a strategic asset, not because of short-term price potential, but because of its position within a tightening system. When supply constraints meet structural demand, value doesn't always appear immediately, but it tends to emerge over time, which means this phase may not be about chasing momentum. It may be about recognizing an accumulation window while it still exists, a period where price hasn't fully aligned with underlying pressure. For short-term traders, the dynamic is different. As imbalances grow, so does volatility. Price may remain controlled for a time, but when movement does come, it can accelerate quickly. That makes timing more sensitive and signals more important. Inventory levels, delivery stress, and physical premiums start to matter more than headlines, because they often move first. And that brings everything back to a single idea. This isn't about predicting the exact moment the market reacts. It's about understanding what's building before it does. Because once that reaction becomes obvious, positioning early is no longer an option. It becomes a missed opportunity. Step back for a moment. Strip away the charts, the data, the projections, and what you're left with is something much simpler. Pressure. Not loud, not obvious, but persistent, building quietly beneath a surface that still appears stable. Demand continues to pull. Supply continues to tighten. And yet, the price, at least for now, remains relatively calm. But markets have a pattern. They can delay reality. They can smooth it, stretch it, even disguise it for a time. But they don't remove it. Because eventually, fundamentals assert themselves. Not gradually, not politely, but decisively. And when that moment arrives, it often feels sudden, unexpected, as if it came out of nowhere. But it never does. It was building all along. Which brings everything back to where we started. The signals are there. The imbalance is forming. The pressure is real. It just hasn't fully shown up in price yet. And that creates a narrow window, a space between what is happening and what is recognized. A moment where understanding exists before confirmation. Because once confirmation arrives, the opportunity usually doesn't stay behind. It moves fast. Markets don't ignore reality forever. They absorb it until they can't. And when silver finally reflects what's been building beneath the surface, will it still feel early? Or will it already be too late to act?